the Capital Roundtable. I'm Tom Nunemaker, and with Brian Larson as our guest today. Before we get started, we have a quick disclaimer that Capital Discussion is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, it is for educational purposes. And Brian, welcome. It's first time speaking, and really look forward to hearing what you have to say. But for people who don't know who you are, maybe just a short background of who you are, your options trading experience, and maybe just so they can get to know you a little bit.
All right. Yeah, like Tom said, my name is Brian Larson. I live in Minnesota, and I've been trading for about 7 years now, and focus pretty much exclusively on this income style of options that most of you are familiar with for about the last 4. So it's been really the thing that kind of propelled me to success in my trading career. I was determined to make it as a trader, but some of the directional strategies I tried when I was first getting started just they weren't really working too well for me, and this fits my personality and lifestyle a lot better. So today I've got a presentation prepared, what I call the Rhino trade, to share with you, and hopefully you find it useful, and feel free to ask any questions or comment as we go along.
Okay, and don't forget to share your desktop.
Yeah, I'm looking for that button now again.
Just try hitting Control-Alt-D, see if that works.
Oh, all right.
Yep, there we go. Loading.
Okay, there we are. All right, so can everybody see that the Rhino in there? All right, good. All right, so just a made-up name for the trade. You'll see as we go along that the combination of butterflies and calendars that I use kind of resembles the Rhino horns to some extent. And I also kind of like the thick-skinned nature of this trade. It's pretty rugged to moves in either up or down direction, especially down. And I guess that's where we take most of our risk, and it's nice to be robust to moves in that direction. So the intent of this trade, at least the way I view it, the way I designed it, was first priority is to preserve our capital. We can't take a big hit on our trading account and expect to have good success long term. Even if you could recover from a big hit, financially, it'd probably be pretty tough from a mental standpoint. So this trade is pretty rugged against up and down moves. Like a lot of our income option strategies, like the M3 was kind of where I cut my teeth. It is delta neutral, and I strive to keep it pretty low gamma. I'm usually out of this thing with more than 21 days to expiration, if at all possible. And if it does get lower than that, then I'm trying to reduce size and get out with a good profit still. Second priority, I wanted it to be easy to manage, kind of the once per day, end of day adjustment. I actually do a lot of my adjusting, not quite to the end of the day, more like in the 1 o'clock to 2 o'clock Eastern. That's just when it works in my schedule. But I found that even that works pretty well. The timing of the adjustments isn't super critical. We have guidelines. There's points at which market price and or delta will make us want to make an adjustment, but whether it happens that day or the next day or there's room for personal judgment, and it's probably not going to hurt too bad if you miss it by a day. And then third priority is to profit. Obviously, that's why we trade, but I feel like capital preservation should definitely be number one. So the target profit on this is about 10% on planned capital, and usually average more in that 5 to 6 range. 10% is a really good month. 5, 6, 7, 8 is probably more typical, and then there can be some small losses, obviously, or even a 10% loss. And another thing I like about this one is that when in the initial stages of a trade, the new trade is extremely rugged and so safe that I don't have a problem overlapping 2 monthly expirations for the 2 or 3 weeks that they could overlap. If I'm fully scaled into the near month, I probably wouldn't want to fully scale into the second month, but that usually doesn't happen that way anyway. And you can always just choose to hold off on the scaling. So with that, we'll get into just a little bit on the design of the trade. I use primarily a combination of 3 common option spreads. The core position is broken wing butterflies on the put side, and then as the trade goes on, we'll mitigate upside risk with call calendar spreads. And then later in the trade, sometimes it makes sense to add broken wing butterflies, and sometimes those are replacing the call calendars at that later stage in the trade. This can be traded on a lot of instruments. I do it on the RUT and the SPX. I'm usually in between 56 and 84 days to expiration. Again, that can be tailored. That's a wide range. You could even go longer than that. It wouldn't hurt anything, but I found that that's kind of the optimal range for me. The market will tell us when we need to make our adjustments. So that's kind of nice for those of you who aren't interested in trying to call direction or good at it, that you just kind of react. Like I mentioned before, there are delta guidelines, but really the shape of that T+0 line is more important than the delta guidelines, and then also your own risk tolerance. There might be times on an adverse move, especially to the downside, that you'll choose to make an adjustment prior to hitting the delta guidelines. And you can do that. That's just fine. It might limit the max profit that you'll get out of that trade. It might expose a little more risk to the upside, but oftentimes it can make it a lot safer position too. So, and then I usually, like I said before, I usually get out before that gamma gets too high and hard to handle. I feel like if you get too far under 21 days to expiration, then you almost need to be day trading your positions and not doing the once a day thing, unless you've got it really widened out and flat, in which case then you can take it a little longer. In these examples, I used a planned capital of $25,000, obviously scalable, but it can go down. I've traded these as small as 12 to 15,000, and as big as 50 myself. Obviously, much higher than that is possible too. I use these kind of rough guidelines for profit targets. If it's greater than 35 days, I'm looking for a full 10%, and then I kind of just lower it by about 2% as time goes on, get less and less greedy. So looking to get out with a good profit. In this example, I'll be using the Russell with 77 days to expiration for entry, and I actually have 4 example trades put together. 3 of them are pretty complete, and well, they're all complete, but one is the 2008 crash, just to kind of illustrate the robustness of this trade, not to suggest that you have necessarily traded it exactly like that. But yeah, so we start with, on a $25,000 trade, we start with 5 put broken wing butterflies that go 40 points up and 50 points down, with the upper long about 5 to 15 points in the money. And then we scale in if price exceeds 10 points above the long strike for a little amount of time, with the caveat that there is some actually some delta there. If it's really flat, then you can choose to scale or not to scale. And then we got a few more guidelines here. We just reduce our negative delta by buying out of the money call calendars, and that'll, when we're fully in to the position, and I call fully scaled in when we've got 10 total put broken wing butterflies. So we started with 5, we added 5. At that point, we'll allow a delta of minus 50. And if we haven't fully scaled in, we'll only allow a delta of minus 25. If we, in the event of a down move, we will want to reduce our positive delta by removing calendars, rolling back the put butterflies, or removing the upper put butterflies if fully scaled in. So that's kind of a mouthful, but that's kind of the 3 different techniques we use, and we'll probably see all those in the examples. And then to the downside, or on a downside move, the delta limit is positive 25. And then late in the trade, if price is threatening to move through our calendars on a strong upside move, that's when I like to sometimes switch from calendars, take those off for a nice profit usually, and then replace them with the call broken wing butterfly. Can really do a good job of flattening that T+0 line, getting rid of some gamma out there, and it's a little more rigid defense to the upside. All right, so that was kind of a lot and kind of fast probably, but I'll make this PowerPoint available, and you'll have the recording to look at if you need to go back. But so I've got 4 trades that I put into this presentation. Kind of your typical, I call it an easy trade. Nothing's really easy, but a trade that doesn't really threaten too hard in either direction, although there is some decent moves in this trade, and that's one that we just had this summer, I guess, the September one. And then I put in what I call a significant down move. If you remember last October, we had a pretty good correction with the Ebola scare and all that. So the November expiration would have been the trade here that saw the brunt of that move. Then I looked for a significant up move trade that we had in April of 2015. Was a pretty good one. And then we can maybe just go quickly through the November 2008 crash that I think it was 44 or 45% down, and just kind of see that you never were in too much trouble with this trade, which is kind of nice to be able to survive that. So we'll start with the easy one. September 2015. I'll spoil it ahead of time here. We were in the trade for 34 days and basically hit our 10% profit target. So I didn't include price charts in these trades. We're just going to be trading off of option view and what the prices are. And then I only included, just to keep this presentation moderately within the time frame, I basically only included the adjustment days. And for the most part, I included what the graph looked like prior to the adjustment and then after. So if you want to see how far we let it roam in between, then you might have to back trade some of these yourself and take a look. But anyway, so because of the holiday, we're going in, the 4th of July holiday in the U.S., we're going in with 78 days to expiration, and we just bought 5 of those 1260, 1220, 1170 put broken wing butterflies, and the delta was -7 on entry. The Russell was right around 1250. So a real typical looking entry there on July 2nd. Now, so July 14th, 12 days later, the Russell's moved up about 24 points, and now it's 10 points above our long strike. The delta was about minus 18. It's time to scale into the second half of this position. So we're going to add, we're going to buy 5 1280, 1240, 1190 foot broken wing butterflies. Now we're fully scaled in, and that would have made the delta 2 negative. And so we bought 3 of those September, October 1300 call calendars there to just reduce our negative delta. And so the delta is at about minus 28, which, if you'll recall, is within the guidelines for being fully scaled in. And so that's our position. It's hedged off a little to the upside, still has a lot of room to the downside. July 24th, 10 days later, if you remember this, there was actually a pretty decent sell-off towards the end of July. This summer, every time I tried to go somewhere on vacation, I got a big sell-off. I think it happened 3 times. So this was not a huge one, but the Russell came down quite a bit. And so now we're down at 1227, and our delta is above 25. It's 30. So my favorite adjustment in this case, when you're kind of up, you're doing pretty good in the trade. It looks like we're up 1,700 or so right now, with 56 days to go, which is doing pretty good pretty early in the trade. My favorite adjustment in this case is to take off the upper set of broken wing butterflies. And so we'll do that, and it looks like that. If you kind of look at what happened to the absolute risk there, I went back up a slide. It was about 15,000 to the downside, and now it's only a little over 7. So really cut your downside risk, but leaves a nice potential to get a little more profit out of this thing. And look what it does to your upside too. It gives you a lot of room up there, a lot of room to the upside. So that's what we did there. Now our delta is only positive 17. We cut it from 30 to 17, cut it in half about. And yeah, so you can kind of see that rhino shape now. That's kind of why I ended up nicknaming it that. I seem to like animal names for my trades. But so that was July 24th, and then July 27th. Now we're down another 12 points or so, down to 1215. Delta's too high again. We're just going to take off one of those out of the money 1300 call calendars there just to trim our delta. So now it looks like that. Delta's 20. And just a few days later, maybe 10 days or so, Russell hasn't moved a whole lot. I think if I remember right, it ventured down to about 1190 or so, and then popped back up, maybe 1195. Anyway, we're basically at our profit target. Our profit target is 2,500 when we're over 35 days to expiration, and right now we're 43 days away, and we're there. And for me personally, that's close enough. I found when trades are in really good shape and you're most tempted to just leave them, it's probably usually the best time to take them off and book the profits for that month. So that's what we did here. 9.9%, only took 34 days. The Russell is, like we said, 1250 when it was opened, went as high as 1275.9, as low as 1205.2, and so that was a 71-point range, which isn't too big. For that time during the summer, that's actually was a decent range. Now we get that every couple days, but we've got a little more volatility now than we did. So that's that trade. If anyone has any questions or comments.
There was one question. Do you use John Locke's option view volatility settings, or is it just the standard option view vol settings?
That's a good question. I used John Locke's just because that's what I'm familiar with. So I've noticed on these that it doesn't greatly change your Greeks, but there are times that it has more impact than others. So I would recommend, if you don't like that setting, then just kind of figure out what deltas and Greeks work for you, because like I said in the beginning, it's kind of more about how that T+0 line looks and what risks you're comfortable with, and understanding the position more than just what are the numbers of your Greeks. So.
And that 10%, 9% profit looks like it's on planned capital, but you never really got close to that.
Right. That's another John Locke thing, I guess. I do like that planned capital, and I do watch it. I don't like to exceed it. I know sometimes John will exceed it. He considers it an average. I like to treat it as you're trading in a set size, and that's what you're limiting your capital to. But I don't like to give myself credit for, twice the percentage just because I didn't use it. So anyway.
And is there a negative gamma limit for this trade?
Yeah, I saw Andrew's question pop up there, and I don't have an official negative gamma limit. I just kind of know that I want it flatter, and so it's kind of designed into the bailing early thing, and I think I put a profit target of $1,000 if it's less than 21 days. If you've been struggling with this thing and the gamma starts getting up there, I'd be happy to get out with any profit, less than 21 days. So I do keep an eye on the gamma, but I don't have a hard number that I try to keep. So you guys probably can come up with one. That usually early on it's really small, like much less than 1. Later on it'll get into the 2s and in that area, but it usually doesn't get too high. So so definitely there's considerations for gamma, but I don't have a hard limit. So any other questions on that one?
So far so good. That's it.
All right, so we'll move on to the trade I picked out as a significant down move. This was last November. We're in this one for 53 days, so you have to stick around a little longer to get your profits if the market makes you work for it. Ended up with 7.3% on this one, which is pretty good. So September 5th, 2014, RUT was at 1169. We went ahead and bought the 1180, 1140, 1090 broken wing butterflies. And so we're sitting at a delta of -11. So the normal entry there, 77 days out. 20 days later, the RUT's down to 111. So we're down almost 50 points. And our delta's over 25, and it's time to roll back those butterflies. And you'll notice the black dot's a little higher than the model. That actually does happen quite a bit on a move like this with these trades. So yeah, the pricing, the increase in vol, a lot of times will have your trade up more than you'd expect, maybe from the model. So we're rolling the butterflies back at this point. That's the adjustment on a down move when you're only half entered. And so we basically just sell those for a profit and re-enter. And so we sold the 1180, 1140, 1090s, and we bought the 1120, 1080, 1030 put butterflies, broken wing butterflies. So that was a 60-point rollback. And we're up a little bit of money, and now our delta is -12 again. And this is another area that you can use a little judgment. This is probably the safest rollback, is to kind of roll back to a re-entry position. But if you're not convinced that it's going any lower, or if you think that or if you strongly feel that you're due for a big bounce up and you're shooting to make the most profit rather than be the safest, you could go more towards an at-the-money roll with those shorts. But in this case, I went with kind of the safer route and did the full rollback. So now here, how many days is that? So I guess it's almost a month later. There was a decent run down in between, and I think I looked at that on option view before this, and I wonder if I could show it here without screwing things up too bad. Yeah, here it is. So this was the as low as we got on the down move here. This is as bad as it looked, at least in the half-hour increments that we have on option view. It got down to, I think, about to 1040. This is showing at about 1047. So that's, we just let it go all the way down there. We didn't hit any delta limits. We didn't exceed even the break even of our 10th there. And then it bounced all the way back up. And so this is 8 days after that lowest move. If you remember here, that was when the Bullard QE4 comment came out, and that was one of the bigger V bottoms we've ever had. I think it bounced up harder than it went down in that case. But so now all of a sudden we're negative delta. We're too negative, and yet we're not past our long strike, and we're only 29 days from expiration. So in this case, we're just going to add the call calendars in. We'll just add the call calendars in to reduce our delta. So we bought 2 of those, and now our delta is at -20. So it looks like we're in good shape. And then just 4 days later, we hit our reduced profit target with 25 days to go. So we were looking for only 1,500 at that point, I believe. And so yeah, 7.3%, took 52 days. So that was a pretty significant down move, and that's the nice thing about these down moves is they really hold up well. And I think I saw a question about switching from a positive delta to a negative delta, and that is a very good question. So if you're more of the contrarian and you don't want to buy into the fact that it could really be crashing, it's perfectly fine to under-adjust those when you roll back. And you could have done that. I didn't model it. I didn't do that in this case. You would have been fine. But this one probably ended up better than that would have because of the continued down move. But so in any case, this the Russell moved in a range of 133, 134 points there, and there wasn't a whole lot of stress. There was one rollback and some calls or some call calendars. So this is one of the reasons I really like this kind of trade is you don't lose a lot of sleep on big down moves. It can be more frustrating on big up moves that don't pull back, but to that side there isn't really substantial risk. I mean, it's pretty minor. Previous slide again. Is this the one? Somebody asked about the previous slide.
I think so.
Yeah, so we just bought 2 of those call calendars to correct that negative delta, and it brought it from -36 to -20.
And then did you see the question, are you entering as put butterflies, or do you scale in with iron butterflies, or does it make a difference?
I use put butterflies. That's just more familiar to me. The fact that the upper one is kind of at the money and the other 2 are out of the money, I think you get pretty good pricing on that. I would be just fine if someone wanted to use irons as well. I don't think it would substantially change the behavior of the trade.
And Mohit asked, do you enter these trades when the market/index had a big move up or extended move up?
I usually like to just kind of get in based on the calendar, based on timing. Just in my experience, I've found that waiting for a certain set of conditions can be, I don't know, maybe I'm just not that good at it. And then I trade like 5 or 6 accounts, and I have a lot of things going on. So it's almost easier just to keep layering into the trades as they become due, so to speak. What I will do is on these Russells, if let's say I enter them at 77 days, I'll probably do my SPX trade more at like 60 then, to just kind of, it'll go into that same monthly expiration, but 17 days later. So chances are the market's at a different point, when we enter those. This trade would work really well if you'd already had an extended up move and you were expecting a modest pullback, and it would have a very hard time outrunning it to the upside if there had been a strong up move. But on the other side of that coin, in low volatility, the butterflies cost a little more. And so it would be really hard to take a loss in a situation like that, but you might not get your full profit either. It might just take too long for that profit to inflate to the levels that you want. So it seems like there's always a trade-off, and nothing's free. But anyway, so it works good really either way. I probably wouldn't, my least favorite time from a hassle standpoint would be if the market had just moved down sharply. You'd get your butterflies cheap, which would be good. But if it goes 150 points against you back up and you have to chase it all the way, that could be irritating. So, but again, you're not going to do a significant damage to your account up on that side. There just isn't a big drop off up there, but it can kind of bleed on you a little bit. And actually, that's what we'll look at next, is a pretty big up move, kind of a poorly timed entry, I think you could say, from if you'd have picked a day or two later, it would have been a lot better, but that's how this one worked out, and it still was okay. So this was our April expiration of this year, and we ended up having to stay in this one for longer than I prefer as well, 54 days, but we still got a decent profit out of it. So this is way back, January 30. If you remember, we had a pretty good shakeout in January. I remember that caused some of my M3 type positions a little bit of distress, but got out of them okay. But this was 77 days to go, and we just hopped in at those 1140 butterflies there with the RUT at 1170. And our delta was -2. When the delta is low, it means that the vol was up a little bit. So real safe position. Butterflies fairly cheap, and we're in. So that was January 30. Just a few days later, it's at 1193, so we're up 24 points. And time to scale in. So we scale into this guy, and our delta is still only -13, so we still don't need any calendars on for that upside protection yet. Even though we had that 24 points and we added a little bit more negative delta to it. At this point, I'm thinking that we're still going to correct. We're not going to just run off, but of course we just run off as we find. So 9 days later, now we're another 20-some points higher, and we hit our negative delta limit. And maybe I didn't make that clear in the guidelines, but when you're in this position and you're way outside your tent and you don't have any upside hedges on, then we don't want to let our delta get to minus 50. If we have either call calendars or call broken wing butterflies out there kind of propping up that side, then we can allow a delta in that minus 50 range. We're going to buy a couple here to knock it down. And so we only trimmed the delta by 10, but we increased our theta out there too, and now that's how it looks with 64 days left. So this has all happened in 13 days. It's gone up almost 44 points. So went back another 5 days, we're up again, another 10 points or so, and then our delta out there is minus 29, and we're way up. We're threatening our upper call calendar area, so we're going to buy a couple more to knock that down. And so we do that, and we bought them 20 points higher, I believe. The other we had 1240s and then 1260s, and cuts the delta down just a little bit, and again kind of increases our theta out there. So you can see we're leaving ourselves with pretty good room to the downside. And if you guys watched Ron Bertino's weighted Vega presentation, you'd come away with the impression that these calendars are a lot more Vega neutral than Option View would suggest. And I would agree with that based on performance here. They'll take a little bit of a hit as that vol crushes when they go in there. But Option View makes it look worse, and then Option View also exaggerates how nicely it will pop the profits on a down move of those two. So early in the trade, those calendars are a better upside hedge than you'd think, and the Vega increase doesn't help you a ton on a down move either. But so that's why we like to keep a lot of room to the downside on these. So if you can see there, the T+0 line has another 5% or so to the downside before it goes back underwater. And then so that was February 17th. So a week later, we're up another 10 points. We just keep running on these. Again, we're over our minus 25, and we're a long ways from our put butterflies. So we don't want to let it to get minus 50 out here. We'll let it get to minus 50 like in our tent or on the edge of the tent. So this time, what I chose to do is roll forward half of those short puts, the ones that are at 11:30, I believe, to prop that up. If you buy too many calendars, actually I like to be at kind of two different strikes. I don't like to get too many and then really cause the big dip. I don't know, the sea of death or whatever people like to call that. I don't like that to get too deep. So in this case, we can reduce our delta and increase our negative Vega a little bit with just a little roll there. So we'll just take 5 of those. I guess they were at 1140, and we'll roll them ahead to 1150 and knock that delta down a little bit. So we're not trying to chase it too hard with our core butterfly position. We're just trying to prop it up at this point. And that's kind of I would caution against trying to get too far on top of the market, because usually you will get your pullback and your chance to profit on this. And so you'll want to maintain some of that negative delta and some of that space between between the current price on a big extension and where your profit zone, your primary profit zone is. And so we had quite a stretch there, but we made it. I think in the meantime here, sorry, I've been bouncing back and forth. Between February 24 and March 17, there was a decent pullback that didn't result in us hitting our profit target because of how much we had to hedge. So it ran down a little, not a lot. I think maybe about to that 1200 area, if I remember right, and then bounced back up, and now we're making another run higher. And so we're up to 1242 at the end of this day, and so that's 72 points above where we entered. And so now we're 31 days, so it's not late in the trade yet, but this is, I kind of did this for example purposes. This is an area where I start to consider taking profits on these calendars and putting in a broken wing butterfly, and hopefully it'll be obvious why here. So I took all the calendars off, and I put in 3 50 up, 30 down broken wing butterflies. And so now we're really flat, and we don't have really any upside risk to worry about, and we've got a long ways now on that downside before it even starts to slope. So this is kind of a move I like when I just think that the market might just keep going on me, and you don't want to just sit there and wait for it. So I can't tell. It looks like we're up about $1,200-1,300 right now. So it's not doing badly, but now we're really in a safe position. And so it keeps going up. Now we're up another 12 points. Now it's 1254, and it actually exceeded our delta for being out in the front edge. And so now I'm just going to take one of those short calls from that butterfly and roll it up, just 10 points, just to prop it up a little more theta, a little less upside risk. Barely trims the delta. Kind of just keeps it so you can hold it a little more safely. And then it's up another over 10 points again a few days later. And so I'm just going to roll another short call there. And so we did that vertical and cut the delta just a little bit. You can see now that the upside risk is almost entirely gone, and we don't really start losing anything on the downside for quite a while here. It should be pretty apparent that we're not going to get a ton more out of this either. So just tweaking it and trying to hit our profit target at this point. And we actually got a down move finally. I think it hit as high as, I guess I wrote 1268. So it went up a little higher and then pulled back. And I checked a bunch of these different days in here, and it wouldn't have mattered really when we got out. The profit stayed above the model pretty consistently for a number of days. But you can see that T+0 line is just flat. And to me, that's really cool. To be, we're 23 days from expiration, and to have that little gamma. Obviously it's not a huge winner either. I'd probably prefer the big winner, but that's a nice profit on a $2,500 trade. So in this case, we had a range of 114. It was almost all to the upside, and we're able to kind of stick with it. And so you see on an up move, there just isn't that much risk there. You can kind of just keep working with it, and most of the time I don't even really entertain the thought of bringing my put butterflies higher. When it has this kind of range, if it wants to outrun it, I might just close it. I don't like to leave my downside open just because I'm overly concerned with what's happening on the upside. So anyway, any questions on how that one went?
Yeah, a couple. Do you have a look at the delta to theta ratio? Do you use that at all?
No, I don't, but I do look at theta, and that's another part of the reason why you're trying to get out early. Like if on this trade right now, if we hadn't exited it and you back up another couple percent, you're not going to have any theta. It's going to go negative. And so then you'd have to do verticals or butterflies, or you'd have to do something. You could take your 1,200 longs and roll them up or something, but lot of things you could do to get theta back in it, but oftentimes I'll just move on, you know, if I've got a nice profit. So I do look at theta. I don't like it to go negative, but I don't really use that ratio too much. Mostly because with really low deltas, it's really easy for a ratio to get to really move, you know, when one of the numbers is really small. So.
And a couple people have asked, how long have you traded it and what kind of results have you gotten?
I've been doing this one. This is kind of a development project that I started at the beginning of this year. I've been doing the broken wing butterfly concept for a lot longer, but using this calendar and broken wing butterfly upside hedge strategy has been mostly this year, and the results are pretty typical to be what I plan on for myself is about a 5 or 6% average, including losses. So the ones I showed you were average higher than that, and I don't believe I've taken a loss on any of this strategy as of yet, but I feel it's smart to plan for them because I will voluntarily take a loss. Well, actually, I take that back. I just took one on this that Monday, Black Monday. I closed one. I was on vacation, and I took a 2% loss, and I wouldn't have had to. It was pretty early in the trade, but like I said, I was on vacation, so, and that was a pretty spooky day, so I just bailed out of it. And that was the first loss, and it was only, like I said, 2%. So they're pretty few and far between if you manage them and you don't get market crashes. And so, let's see. I see what was the target loss level. My max loss level is 10%. I have a hard time. I would have a hard time letting it get that bad, and not that it couldn't. You're most likely to get a max loss, like any of these style trades, if you're starting to get late and you get a huge down move late in the trade after you've got some gamma. Personally, because of my desire to preserve capital, if I was doing okay and had a little gain and I gave it all back in one day and it was charging down the backside and looked really bad, I wouldn't feel bad about just taking a loss on it. So I like to plan for that. But like I said, it's only been the one time so far this year, and that was a fairly exceptional day, really. And it wouldn't have, had I just rolled it like I probably would have if I was actively trading the markets instead of going on roller coasters with the kids. It would actually be doing just fine right now, but I don't usually worry too much about ones that like get away either. So if we can kind of just, if there's no more questions on that, or if there are, I can answer them, but otherwise we can just quickly go through the big crash that I always go to this one for, I consider it usually my most important back test. It's about the biggest crash that's available in OptionView, and that's happened in my memorable lifetime. So I like to just run my trades through this scenario just to see how bad it would have been. So full disclaimer, this is entirely back traded, and I probably would have never hung on this long, but I guess the idea was, you know, what if you had, and, you know, just how bad would it be? So so I didn't show all there's so many adjustments on this one. I didn't show all the pre, I just have the after adjustment snapshots. So our entry is the 690 butterflies at 717, when the Russell's at 717. And the delta is positive already on these and that just means that your vol is already up a little bit, and we're not even to the crash yet. So there was some hints here, but so we're at 717. All of a sudden we're at 659, and so we roll it back all the way from 690 to 630. Remember, this is, the Russell's only a little over half now what it was, or at this time, than it is now. So a 60-point roll was bigger in 2008 than it is now. So now we're still positive delta. We're drawn down a little. Our fills might not have been this good. There's always that to consider, but you're not in a dangerous position. 2 days later, now we're down another 77 points or something like that. And so we roll it down some more. And I'm not sure, maybe I overrolled that one, I don't know. But another 80 points down. Now we're delta flat. And actually not doing that bad P&L wise. Probably wouldn't be doing that as well in a real scenario. Now we're down again. It just keeps outrunning. You're not seeing it outrun the back of these butterflies, but it is, and I'm just rolling them. So it's always looking like they're always at the front, but they're going way out the back, and I'm just moving them according to what price option view is giving me. So we're still negative delta. You can see the T+0 and all the other lines are kind of weird looking. It doesn't know what to do, I think, with some of this volatility. It's getting pretty high. Now we're down another. We started at 717. Now we're at 479. So that's a big move, and we're still just rolling with it. And you can see we're getting more and more upside risk as we go, obviously, but it's only to like $2,500 right now, on the upside, and would maybe be a little more, with poor execution and fills, but anyway, you're not seeing a disaster unfold anyway. And then, so at this point, I think it continued down quite a bit more. I think it got down in that low 400s range, and then bounced way up to 530, all within that 8 days there. And so we just threw on some of the broken wing butterflies there to at least poke the top side out of the water and take off some of that upside risk. And there's only 21 days to go right now. It basically spent this whole trade charging out the lower side of the butterflies. And, I've said it a few times now, but I'm not sure I would have done any of this. I'm just saying you could have, in theory. And added another called broken wing butterfly to take the deltas down a little bit. And then it moved down sharply again on us, but it happened late enough that if you had wanted to and been crazy enough to do it, you could have gotten $1,200 in 68 days. And yeah, so the range was 319 points on this guy, 44.6% range, almost all of it down. Here's the chart. That's what this trade handled. Like I said, probably would have been a loss for most people, but it wouldn't have been a disaster. And anyway, but I always like to run my trades through that scenario just to, I don't know, I can't picture things getting a whole lot worse than this. And if they did, I don't think it would be a whole lot worse for this trade. You'd just have to get out with whatever you can get out and be done with it. But so anyway, so yeah, I said you could have exited at any time for a small loss or maybe a small profit at a few different points. But that was the big move there. And that's the end of my long-winded presentation. So if anyone has any questions on anything they saw or would like to look at anything again, I'd be happy to answer.
So there was another question. What's your experience with volatility increases or decreases early or late in the trade?
Let's see. Yeah, so that's pretty much all the scenarios. Volatility increases early in the trade are usually no big deal. They're usually accompanied by a down move, and usually you're pretty robust there with typically the delta starts out negative, especially if you had a not too high vol to begin with. So your first move down is actually in the profit. And that was the scenario that we had just last week, where this one blew me out big time on an SPX Rhino, and I had just the broken wing butterfly on, and like I said, I took a 2% loss with a pretty bad fill probably, and it wasn't that big a deal. Volatility decrease early in the trade is also no big deal. You know, usually accompanied by a down move and allows you to scale in. So then later in the trade, obviously, is when it becomes a little more sensitive to those things, especially when you're fully scaled in and you do actually start to get a little gamma and some curvature to your T+0 line. The decrease in vol, if you're up in the front, up in the calendars on the top side, it can start to erode your profits or draw you down a little, and that's why later in the trade I'll sometimes replace them with the broken wing, because it's a little more rigid and the profit will kind of suck up into that a little better than it will a calendar. And then a vol increase later in the trade, usually if that happens, you've got a negative delta when it starts, and so if it's quote unquote later in the trade, and that's partially why I have decreasing profit targets as time goes by, I'm more willing to just take the money and run. But so if you had negative delta to begin with and it explodes on you to the downside, it's usually not a big loss. And in fact, sometimes it doesn't even draw down. It would depend on the extent. I haven't been in one of these live, you know, fully scaled in where we had a day like we did Monday the 24th, I believe it was. I would assume that would have been, you know, hurting pretty bad, and maybe even a max loss, but not, you know, not catastrophic. So anyway, I think I covered the different scenarios there.
Yeah, and here's a question: do you prefer a special chart setup or market condition to start a trade? I think you said you usually to start on time, right?
Yep. And in terms of starting on time, I mean, be flexible, make up your own time. You know, if you have something going on where you just don't want to think about it, go ahead and start it later. The timing isn't so critical, but when you're 77 days away or in that ballpark, it's so insensitive that even if you thought you knew what was going to happen in the next week, it would maybe have no bearing on how your trade ended up, even if you were right or if you were wrong. You know, so it's kind of like just get it on, and when you get it on early, you pay less, and you can just kind of let theta start working for you and let the market tell you what needs to be done to the trade. I found that that's kind of mentally it's easier on you, kind of takes some of the onus off yourself and puts it on your system, you know, rather than trying to wait for a perfect setup.
Mohit asked, do you keep out if the VIX hits a certain level?
No. You know, and some of that will be trader preference. Like, you know, since I'm actually in between right now. This is a good scenario. I'm in between my Octobers that I got blown out of and my Novembers right now in terms of entry. And I plan on just putting them on time. You know, this isn't a world-beating VIX condition by any stretch, but you know, some of the more pessimistic amongst us, you know, might be sensing a down wave in the market coming. And I wouldn't be afraid of putting it on. But that being said, if you think, well, I just want to wait and see what happens and want to stay flat for 2 months, you know, all that costs you is whatever potential profits you could have made too. And it could save you some potential losses. So, but again, that kind of turns out to be market timing, and if that's your thing, maybe you're good at it, maybe you're not, but I wouldn't be afraid of it in any mixed condition.
And then David asks, is there any advantage of hedging upside with calendars versus call broken wings, or vice versa?
Yeah, that's a good question. I figured that one would come up. That one, early in the trade, I like to call calendars. They're kind of a softer hedge. They're not too expensive early on. They provide you some decent delta and some decent theta, and they do an okay job. And so on an up move, they'll gain value, and then you can add some more higher up, and those will gain value too. And I don't like them to get outrun to the upside. And so if it looks like they're going to get outrun, that's when I'll usually take them off for a gain. And that broken wing butterfly is a little more rigid, and because I usually do the 50 up, 30 down, they're kind of expensive, but they provide a pretty solid upside hedge. And so usually it ends up bringing your farthest right portion of your expiration graph to where it's barely below the break-even line. And so you end up with a little tent, not a big profit zone, a little tent out on your call side, where if it just sits there, it'll profit, and you have your bigger tent lower down, and you can always, if you get that down move, then you can always take some of those butterflies off, some of the call broken wings off, or you could even roll some of those shorts down closer and prop up your backside. So it's kind of just what I found is a comfortable mix. Could you just go right to the calls or to the broken wing calls in the beginning? Yeah, you probably could, but this is what I found works better for me.
And then the last thing isn't a question, it's a comment. Donald's thanking you for a really good presentation. He really liked it, and David echoes that, and so do I. So really appreciate it, Brian. Really nice presentation and a really interesting trade.
Great. Thank you guys for the comments, and thanks for the opportunity to share it here. I've gotten a lot of benefit over the last year or so from these roundtables and from all of capital discussions, so I thought it'd be good to share what I've been working on. So.
Yeah, really appreciate it, and I've already set you up with the gold membership, so you're good there. And if you would just send me the slides, I'll attach it to the recording for people to download.
Okay, will do.
Okay, well, thanks everyone. Really appreciate it, and we will see you next time. Thanks, Brian.
Okay, thank you, Tom.
Thanks. Good night.
Bye.